All right, let's talk about financial markets. We're going to pull back the curtain and demystify the whole thing. Our goal here is to strip away all that confusing jargon and show you the simple, powerful engine that's actually driving everything.
So let's just dive right in with the big one. The question I think is on a lot of people's minds. Is the market just a giant rigged casino that's designed to take all your money? It's a totally fair question, especially when you see those wild swings day to day.
Well, according to the source material we're looking at, the answer is a pretty clear no. It's not some kind of black magic, and it's not a grand conspiracy. It's actually something much, much simpler. And today we're going to break down that engine and see exactly how it runs.
Okay, so first things first, let's clear the air and get this out of the way right now. Markets aren't magic.
You see this contrast all the time, right? On one side, you have these big, scary myths that the market is just a slot machine, that it's all smoke and mirrors, or even that it's a form of theft. But the reality, it's way more down to earth. It's just people, humans, trading things with each other when nobody knows for sure what's going to happen next. That's it. That's the core.
So, if it's not magic, what is it? What's the force that actually moves prices up and down? Well, that brings us to the single most important concept, the real heart of the machine. It's all about the engine, supply and demand.
And you know what? It really is this simple. You can forget all the crazy complex charts and jargon for a second. At its core, when more people want to buy something than there are people selling it, well, the price just has to go up. And on the flip side, when more people are trying to sell than there are buyers, the price goes down. That's the whole game.
And this isn't just some fancy Wall Street rule. It's absolutely universal. It applies to everything. The very same dynamic that moves stocks in New York is what sets the price for cocoa beans in Ghana, for a piece of land in Nairobi, for gold in London, or even for tomatoes at your local market. It's just how people work.
Let's make this real with a quick story about a cocoa farmer. Imagine one year the price for cocoa spikes. It's super high. What do all the farmers do? They rush to plant more cocoa to cash in. But a few years later, all that extra cocoa hits the market at the same time, creating a massive flood of supply. And, you guessed it, the price crashes. See? Not a conspiracy, just simple supply and demand in action.
Okay, but if the engine is that simple, why does the market feel so chaotic and completely unpredictable sometimes? Well, that brings us to the wild card in the whole deck, the human factor.
Benjamin Graham, who's basically the father of value investing, gave us the perfect way to think about this. He said, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. So let's break down what that actually means.
In the short term, the market is just a big popularity contest. That's the voting machine. Prices are flying around based on emotions, on hype, on fear, on what's trendy. But over the long run, reality always wins. The market becomes a weighing machine, carefully assessing the true fundamental value of something. And that's the difference that changes everything.
So now that we have the basic mechanics and the messy human emotions, how do we put it all together? Let's get into a few powerful ideas for decoding market behavior.
Now, this is a big one that a lot of people miss. Markets are always looking forward. The price of a stock today isn't about the good news that came out yesterday. It's about the collective guess of millions of people about what's going to happen tomorrow. That's why a company can report record profits and the stock still goes down, because everyone was expecting it to be even better.
And next up, you have to understand that everything moves in cycles. Economies breathe in and out, they expand and contract. Businesses grow, then they slow down. This isn't a bug in the system, it's a feature. It's the natural rhythm of things. Seeing a downturn as just a normal phase instead of a total failure is a huge mental shift.
And that idea of cycles leads us to this really powerful concept about market crashes. They aren't random glitches. They're not a mistake. They are resets. They're the system's way of hitting the reset button and correcting itself.
I mean, just look at history. The pattern is crystal clear. Crashes don't just appear out of thin air. They always follow a period of, well, excess. In 1929, it was too much borrowing. In 2000, it was way too much dot-com optimism. In 2008, it was a mountain of debt. The crash is just the painful, but necessary, hangover after the big party. So, knowing all this, understanding how the machine works, how people behave, how can you, as an individual, actually find an advantage? That's what this next part is all about, the investor's edge.
Okay, this might be the single most important distinction in all of investing, the difference between price and value. Price is just the number on the screen, it's what you pay, and it can be totally irrational, driven by all that short-term emotion. But value Value is what you get. It's the real fundamental worth of the thing itself. The whole game is about buying real value when the price is temporarily on sale.
And that leads us right to one of the most famous quotes ever from Warren Buffett. He's not telling you to be reckless. What he's really saying is that the absolute best time to find those great deals is when everyone else is panicking and selling, when they're fearful. And the most dangerous time to buy? It's when everyone is greedy and euphoric and prices are through the roof.
Buffett's longtime partner, Charlie Munger, really just nailed the core challenge. He said, investing is simple, but not easy. And that's so true. The ideas we've talked about, supply and demand, price versus value, they're simple concepts. But actually having the emotional discipline to stick with them when everyone around you is freaking out, that's the part that's not so easy.
So, what does this all mean for you? How do you take these lessons and actually apply them? Let's talk about your path forward.
Honestly, if you only remember one thing from all of this, let it be this. The market rewards patience, not prediction. Trying to guess what's going to happen tomorrow or next week, that's a losing game. The real winning strategy is to stop trying to predict and start to prepare.
And what does preparing look like? Well, it usually boils down to a few time-tested strategies. Things like index investing, where you just own a tiny piece of the whole market. Diversification, so you don't have all your eggs in one basket. And probably most important, just consistent investing over time, which lets you ride out those cycles we talked about and benefit from long-term growth.
So you see, the market isn't some unknowable beast. It's a system with rules, and it's driven by human behavior that we can actually understand. And once you really get that, fear starts to lose its power. So we'll leave you with this question. Now that you know the rules, how are you going to play the game?